So some of the key vocabulary revolve around, the credit analysis that a lender will go through or will complete in order to decide how much money to lend a borrower or whether or not they want to lend to the borrower in the first place. So one key metric is LTV, which stands for loan to value, and basically it equals the loan amount divided by the value of the property that's being financed. This metric is a measurement of risk, of leverage, sorry, and it measures default risk. So it's sort of a metric that gives you insight into the likelihood of the loan's balloon balance being repaid at the maturity date for that loan. A second credit metric is DSC. Sometimes it's called DSCR. It's the debt service coverage or the debt service coverage ratio. It's equal to the NOI or the net cash flow divided by the monthly debt service payment. Different types of lenders use net cash flow versus NOI. So you'll see that calculation done differently depending on whether or not the lender is a bank, a CMBS lender, a life company. And what that measures is the risk of a debt service payment default during the term of the loan. Another metric is debt yield. That's equal to NOI or net cash flow. Again, which one will depend upon the type of lender, the specific type of lender, divided by the loan amount. And debt yield is often referred to as a lender's cap rate. So it gives the lender insight into a normalized return level, which controls and acts sort of like a sanity check for LTV and takes out the subjectivity associated with cap rates. Because when value derivation is done by capping cash flow, there's a lot of subjectivity that goes into the choice of cap rates. So those are basically the three top risk metrics that a lender will evaluate. Some of the other vocabulary is like amortization, composite rate, index, risk premium, or margin. Those are some of the key terms that come up in a discussion of fixed versus floating.